Hey everyone, welcome back to the channel. Today we're diving deep into IREN Limited, the company that's transforming from a Bitcoin miner into a major player in AI data center infrastructure. With that massive Nvidia partnership just announced and a huge convertible notes deal funding the build-out, this stock has been on a wild ride, and there's a lot to unpack for long-term investors. IREN has secured an impressive 5 gigawatts of power capacity across sites in Texas, British Columbia, Oklahoma, and even expanding into Spain and Europe. That's the real moat here, because in the AI world, power and land are becoming the biggest bottlenecks. Management is targeting 150 megawatts of AI cloud capacity by the end of this year, with contracted annual recurring revenue already sitting at $3.1 billion and a goal of $3.7 billion exiting 2026. The company started life as IREN Energy back in 2018, focused purely on Bitcoin mining with renewable power in Canada and Australia. They rebranded to IREN last year to reflect the pivot into vertically integrated data centers that can handle both crypto and high-performance computing for AI workloads. CEO William Roberts has led the charge on this transition, and with 257 full-time employees, they're running lean while scaling aggressively. The market cap sits right around $19.7 billion at the current price near $55 a share. Looking at the revenue picture, last fiscal year they generated $501 million in total revenue, up sharply from $187 million the prior year. The growth is coming from two sides now: Bitcoin mining operations that still contribute the bulk, but AI cloud services are ramping fast with a 9x surge in that segment recently. They're seeing strong demand from hyperscalers, and that Nvidia-backed multi-year deal is expected to accelerate the mix shift toward higher-margin cloud revenue over the next few quarters. On the earnings front, fiscal 2025 delivered a solid net profit of $87 million and EPS of 41 cents, a big swing from the losses in prior years. The most recent quarter showed some sequential revenue softness as they decommissioned older ASIC miners, but the wider net loss was largely driven by expansion costs rather than core operations. Gross margins held strong near 57%, showing the underlying hardware and power assets are efficient even as they invest heavily in the AI build-out. In the latest earnings discussion, management highlighted how the Nvidia partnership covers roughly 95% of GPU deployment costs at very attractive financing rates around 3%. They emphasized disciplined capital allocation, using the new convertible notes to fund expansion without excessive dilution risk in the near term. The tone was optimistic on AI demand, while acknowledging execution risks around power procurement and deployment timelines, but they stressed having multiple sites and power contracts already secured to de-risk the growth plan. The balance sheet has strengthened considerably, with cash at $565 million and total assets now over $2.9 billion. They've taken on more debt to fuel the expansion, with total liabilities around $1.1 billion, but the debt-to-equity ratio of 1.49 looks manageable given the contracted revenue visibility. Free cash flow turned negative at over $1 billion due to heavy capex on data center infrastructure, which is typical for this growth phase, but something to watch as projects come online. From a valuation standpoint, the stock trades at about 27 times trailing sales and a lofty forward PE in the 30 to 50 range depending on the estimate, reflecting high growth expectations. Compared to traditional data center peers, the multiple feels rich but justified if they hit those 3.7 billion ARR targets. The recent upsized 2.6 billion convertible notes offering gives them plenty of dry powder, though it did pressure the shares short-term as investors digested the dilution and leverage implications. Strengths include that secured power portfolio and the Nvidia relationship that de-risks financing. Weaknesses center on the still heavy reliance on Bitcoin mining volatility and execution risk scaling AI capacity quickly. Opportunities are massive in the AI infrastructure boom, especially with European expansion. Threats include rising interest rates affecting convertible debt costs, competition from bigger hyperscalers, and potential regulatory hurdles around energy consumption. Over the past year, shares are up over 220%, though the last month saw a 26% pullback after the notes offering and some profit-taking following the Nvidia news spike. The 3-month performance is roughly flat, showing the market is still digesting the speed of the AI pivot versus near-term dilution. Volume has been elevated, which is healthy for a name this size. All in all, IREN looks like a high-conviction way to play the physical layer of AI growth, but it's not without volatility. The power assets and Nvidia backing give it real staying power if they execute, so dollar-cost averaging on dips could make sense for aggressive growth portfolios. As always, do your own research and consider your risk tolerance. Thanks for watching. Hit subscribe for more deep dives like this, and I'll catch you in the next one.